Welcome to the TFG Aftershow, where our goal is to take you deeper into the things we do here at the Financial Guys offices to help people, to give you a deeper look into some of our key people and prominent difference makers. As always, if you need us throughout the week, you can call 833-FIN-GUYS. I'm Mike Hayflick, along with Mike Sparazza. Great to be here today. We're happy to have two members of our registered investment advisory firm, Independent Solutions Committee, portfolio managers, and chartered financial analysts, John Thur and Meeks. This is a great show, folks. I'm so glad you're tuning in. Gentlemen, thank you for joining us.
Glad to be here.
It's awesome. So good to have you guys. You guys are the ones that Mike Lomas and Glenn Wiggle will often say aren't allowed out of their offices. They're watching the screens, they're watching the numbers, the charts. You're both out there, though. You're both pretty prominent in terms of communications, not only with our clients, but at the national level. Paul often found on CNBC, in fact, pretty much weekly now, to chime in, especially on tech. Guys, I want to start with this. Jay Powell, Paul, you have said that Jay Powell is probably one of the most important people out there when it comes to the economy. Not even the president, when it was Trump, or now that it's Joseph Biden, is as important as Jay Powell. Can you explain that? Because I think that floored me when you said that. I thought, boy, with all the stuff going on with Trump and the left and the media, that has to be more significant than a guy named Jay Powell. But can you explain that to us, Paul?
So first of all, Jay Powell is the chair of America's central bank, which is the Federal Reserve Board. And the role, or at least the key role, of the Fed is monetary policy. And one of the tools that they use is when the economy is in rough shape, they lower interest rates to provide some fuel for the engine. Now, we haven't seen it in a long time, but what they conceivably could do is if the economy gets too hot and we have an inflation threat, they could raise interest rates to intentionally slow down the economy. And so that is, in my view, the key to where the markets have been and where the markets are going. Fiscal policy, which is controlled by Congress, is important, but I don't know if it, at least in this era, is important as monetary policy. And I think so many people get wrapped up because they're watching television and reading the newspapers, Trump versus Biden, Dems versus Republicans, what is the political tilt in the Supreme Court of the United States. And yes, those things are interesting to talk about. And yes, they play some role. But I'm a college professor in addition to my day job. And I tell my students that back off on all the political rhetoric, and the most important person in finance, at least in the free world, is this fellow Jay Powell. And I actually think that the president of the United States, whether it be Trump or Biden or whoever follows, is distant as far as that lineup. May not even be in the top 10, maybe not even be in the top 20 as far as the hierarchy in this particular area in the States. I just think people get too wrapped up and focus too much on the political rhetoric and actually who happens to be in power. If you take a look at stats over a long period of time, all the different permutations between who's president, who controls the House, who controls the Senate, who controls, at least with their ideology, the Supreme Court, over time, it hasn't really mattered. It matters a little bit, but not a significant amount to the performance of the financial markets.
Paul, one question, bring politics into it for a second. If they do pass some of these major bills that they're looking to pass, like let's call it a $10 trillion Green New Deal, let's say, that quick of an increase in debt, though, maybe it's over 10 years, but will that impact it significantly or no?
Yeah, I think it will be. I don't think we'll see 10, but we've already put a bunch of trillions to work, whether it be through monetary policy or fiscal stimulus. Yeah, I'm not a rube. I do believe that could have an evil effect over time. But again, if you take a look at the Dems or the Republicans, they both seem to be very good at adding debt. So it's not necessarily that I think one is that much better than another. at least as what we've seen going back for several presidential administrations over several decades.
I'd have to agree with you on that. John, I want to get back to interest rates for a second. They've been extremely low, and this has been great for many of my clients, our clients that are looking to buy their first homes, maybe to refinance homes, but not so good for conservative-minded investors. So at what point do you think, John, we'll see rates actually climb in a more significant way? I mean, they've crept up a little bit over the last, say, 6 to 9 months, but not too significantly. When, John, do you think it becomes a little more relevant that the rates are climbing?
That seems to be the prevalent question out there right now, Mike. And the problem we have with that, yeah, I could probably answer that more accurately, 20 years ago, when the markets and the investment world, the capital markets, determined what interest rates would be. It's not that difficult. There is kind of a formula when you look at the growth of GDP. Okay, and let's say that's 2%. Inflation is 2%. You add those two together. You add a premium, let's say 1%. And that's where the 10-year usually is pegged. So we should be somewhere 4.5%, 5%. And we're at 1.6. So we're not in a real world here. And the capital markets are somewhat broken because the governments around the world, the central banks, have kind of artificially kept interest rates low. This has inflated all assets. And that's what happens when you do that. If you think about it, the average Fed action, if you go back to the last 50 years, when the Fed has had to step in and raise short-term rates to stem excessive growth or cut short-term rates to avoid a severe recession, they last about 9 months. They've been involved now for 12 years. That gives you an idea of the problems we have. But because rates are pegged at zero, everybody seems to ignore that. And we figured a way around it. And there's been a lot of financial engineering. And when you talk about how people have benefited from these low rates and been able to buy houses and whatnot with a low interest rate, but they've probably paid 30, 40% more for that house than they should have. So it's all about this give and take, yin and yang. And while the Fed is pumping these things up, are they really doing a service for the individual who has to buy a home and bid it up? And the home price is probably not going to be higher than it is what they paid today over the next 10 years. So where I see this going is if the economy starts to grow as we think it can, and if earnings keep coming in where they are, have been coming in with the growth, and it's not going to be as great, but if they continue to grow, there's no doubt this 10-year has to keep moving higher. The spread can go to 200 basis points between 2s and 10s and be at a normal level. So with the 2 down at 0.16, if the 10-year went to 2.16 and you had a 200 basis point spread, that's normal. So that is not going to hurt the economy. It will hurt investments. It'll hurt the growth stocks that when a lower rate is plugged in for the models to determine, current value based on future cash flows, and that's where it gets a little sticky. So it'll hurt assets, but it won't hurt the economy, in my opinion.
So, Paul, on that note, have we completely strayed from the more traditional mechanisms that you've used in portfolio analysis? Or is this more of a decade, or as John, you said, maybe about 12 years where interest rates have been so low? Is this just more of an anomaly and we'll get back to the more traditional charting and the more traditional ratios that you might make decisions upon?
So I would say for somebody like me, who's primarily a growth investor, with a specialty in the tech sector, long ago, unfortunately, and I don't like it, but it's the truth, we've had to put aside some of the traditional valuation metrics, things like price to earnings ratio, price to sales, price to cash flow. And as John's alluded to, when you traditionally value an asset, and I even teach this in the classroom, you try to predict the future cash flows of said asset, and that is the numerator. In the denominator is your discount rate. And your discount rate is your interest rate that has been, at least recently, on the rise. And so when you do that math, particularly for aggressively valued growth and tech names, that is an evil combination.
Yeah.
And so after outperforming for so many years, tech has been on a absolute ramp since 2009. As we rolled into 2021, actually tech is still up for the year, but it's badly underperforming what I call the revenge of the nerd stocks, right? The value stocks that have probably too long not had their day, and they have their day. So take it from a tech investor. I would have more of my money with John Thur and Value Ideas than my own group. And in portfolios where I can have a mix, I reflect that.
It's really a great point. And I know that the conversations that I'll have with my clients have been interesting. Going back a good year till now, it has been a bit of a flip-flop. You know, those that are a little more growth oriented, I guess, are a little bit more humbled this year, a little bit more, I don't know, not defensive in terms of what's going on, but like you just explained, Paul, it's been a shift. Whereas the more value oriented dividend producing stocks that just got so hammered through the COVID crisis that we've gone through, they really they weren't so much the V recovery, they were more of this check mark, right? It was kind of like check mark, and 8-9 months later, we were just about back to the values we had seen. So, John, on that note, like if you're looking at your clients' portfolios, can you just give a little perspective to those listening, how you have to look at this as an investor? Because boy, we are all so hypersensitive to the things that go on from like literally day to day. Can you just talk a little bit about the long view that I think we all have to have as investors?
Sure, Mike. I tell people I've been in this 40 years. This last 10 years has been the most difficult period for an investor like me, who relies on the metrics that Paul had laid out, and they've gotten so far out of line. What I've been educating my clients about is to be in the market. Too many people I know have gotten out. Back in March, they got out, and they tell me I got out and I didn't get back in. I was afraid. I said, you can't do that. I said, you have to be a long-term investor if you're going to be in stocks. You adjust how much you put in the market at any given time, upping and lowering your allocations, but you don't get out. You temper the risk in your portfolio. At times you go and you increase the risk, like in March when the market was bottoming, you increase your risk, you increase your allocation, you increase the risk of your holdings because they are cheaper. And then at times like this, you maybe start to temper and change your profile. So it's about risk. And I tell my clients, don't chase the market for returns. Manage the risk where you're comfortable. And knowing that if this ever fell 30% again, would you be able to sleep at night? So I'm buying companies and picking and choosing companies that have tremendous free cash flow. That is important. We are going into an era, again, not unlike the 08 to 2016, when we had companies not confident in fiscal policies, and we didn't have policies with regard to immigration, energy, taxes, but you had spending, and you had corporations who know, where are we going to get the money? It's going to come from the corporate taxes. So we're going into that environment again where there's uncertainty, and corporations are going to pull back on their investing in the US and growing their businesses. So what are they going to do? They're going to buy back their own stock, because that lowers the amount of shares outstanding, increases earnings per share, even if their earnings don't grow. And therefore, giving the appearance you should be buying their stock, there's more value. So this is what I'm focusing on, getting these companies with great free cash flow and the ones that pay dividends. And that way, I think they're going to give more back to the shareholder. Hence, the price of the stock should continue to move. I think earnings are going to continue to be good for the companies I own. And I also think the economy is going to continue to be decent for at least the next 8 to 12 months. Beyond that, I don't know where we're headed, but I do figure if taxes are going up and debt keeps rising, if you add not only our regular deficit dollars of about 30 trillion. You add 10 trillion in unfunded federal pensions. And then you add in the balance sheet of the Fed, which has grown to about 7-8 trillion and could get to 10 trillion. You could get to 50 trillion. And our economy is a 20 trillion economy. So you're at, over 200% debt to GDP. That's pretty outlandish. So what happens is the debt crowds out growth and you're smothered. And think of your credit card. When you have a 10,000, you're a kid, you're 25 years old, you get a $10,000 limit, you think, oh, wow, I got $10,000, and you go spend it, right? Well, now your credit card's limit out and you can't keep spending like that. And you became addicted to the spending. And what do? You're maxed. Well, I think we're getting to that point with everybody overpaying for homes, becoming house poor, overpaying for cars. They're getting to their maximum. And at some point we will get to that maximum. And that's when the debt's going to become a problem, because everybody's just going to be trying to service their debt, including the governments around the world.
Yeah, and it's so fun when I hear you talk about this. I think I hear this in my client appointments all the time. Like the best client, I guess, experiences often are because of properly run household budgets.
Yep.
People living within their means, knowing that, hey, if prices go up, we're living maybe not at 100% of what we need, but maybe 75 to 80%. So there's like a little cushion built in. And when you mention credit limits, I feel like maybe the national government should really have some credit limits, because the debt is just outstanding. It's just
a business too, right? You can't run a business at 200% extra marketing when you can't afford it, right? Your business goes in the toilet. And that to me, what's just absolutely insane about everything we're doing is the math just isn't adding up, and it's got to come back to bite us at some point, right?
Exactly. And what you're seeing is we are following a path that has been laid out by Japan that has been extremely unsuccessful. So we're doing something that has a proven record of not being successful. So what we're supposed to be doing when the Federal Reserve comes in and buys you time, and they lower rates to stave off the depression, and they come in and they buy bonds, and they do what they have to do, that should last about 9 months, and then fiscal policies kick in, and then get the economy kickstarted, and we're on our way. Well, that didn't happen. And what it was supposed to do was buy time for governments around the world to get their deficits, down, minimize those deficits, get yourself in good working order, and then we can proceed to grow the economy. It's had the reverse effect by giving free money to these governments. They've ballooned their deficits, spent more money, and created a bigger problem than we had in 08. In 08, when the market collapsed, we had 7 trillion in debt. And we thought that was bad. We had 7 trillion. Okay. It had jumped up, I think, from 4 trillion because of the war overseas, but 7 trillion. And we're now at 30 trillion. So I think you're getting a handle how bad this is and how scary it can get. I think we're at the limit. And I think you're starting to see the effects with the cryptocurrencies. The younger investors, the new type investors is making a statement. And whether you agree with cryptos or you don't, they're making a statement that they don't have confidence in the currencies around the world. Because if every central bank was not doing what they're doing, it would affect currency and would devalue currency. But because they're all doing it, the currencies are relatively stable to each other. And that's when you're going to see this, come into light, is when somebody stumbles and somebody can't keep the game going. And that's when it's going to get interesting.
Yeah. Paul, so on the national debt, on the idea of actually having balanced budgets, do you think that we have to get back to responsible spending, or can we just simply grow out of this problem? If we just have just an abundance of economic growth, can we start to rein in I guess really start eroding some of the debt and not just see it grow by trillion upon trillions of dollars? Can we actually grow out of this, or is it going to take administrations across the world, as John has alluded to, of more responsible spending?
I think John's absolutely right. And the long term and maybe even the intermediate term, yes, we have to get there. In the short term, keep your fingers crossed. We will have explosive GDP growth this year. Not my forecast. The forecast on Wall Street is GDP growth this year, 6 or 7%. That would be the fastest growth since 83, 84. That's a long time ago. And corporate earnings are levered to that growth. So if this year US GDP grows 6 or 7%, corporate earnings will probably grow 2 to 3x that. So that's good in the near term. And that will help us grow out of some of this. And as interest rates stay low, we can easily service that debt. But absolutely right. Again, I'm no rookie. I acknowledge that in the intermediate to longer term, yes, we have to get a handle on the gross overspending, both monetary policy and fiscal stimulus.
I want to ask a question to both of you about the ability for two chartered financial analysts of decades of experience to be able to sort of collaborate with one another. How much over your career, John, has it been more, I guess, like a solo project for you versus maybe now your time? And it's been some time now that you've been on our Independent Solutions Committee, which, folks, if you're listening, that's a registered investment advisory firm. It's actually a partnering firm, an entity that's connected with the financial guys. But John, can you give just a little bit of insight on the ability to talk to people like Paul about his perspectives and experiences, and even guys like Dan Neiman, all the rest of our portfolio committee? And then Paul, I want to get your thoughts on that too.
Well, Mike, a majority of my career is spent being part of a team. Early on in my career, I learned so much from the teams I was on, and I was very fortunate to be working with some very smart people, and they have shaped my career, and I can appreciate the importance of it. I spent about 10 or 12 years when I started my business somewhat on my own, but I always had contact with Wall Street and contacts at the major firms and had access, to their resources, but it's not the same. So when I decided to come to Independent Solutions, that was one of the reasons why I came here, was the team effect, was other people to bounce things off of, have conversations, be able to give your opinion, listen to other people's opinions. And I will say it's been great having Paul on the team. I think Paul and I collaborate more and more and appreciate each other's, let's say, specialties, and we share. And, I've been very fortunate to get some ideas from Paul, and hopefully he's gotten some from me. And I think we have two different approaches, two different styles. We bring two different sets and eyes and experience to the table, which I really love. So while Paul and I also talk, Dan and I talk, we talk together, and I have access to many of the top, managers on Wall Street. So I try to read a lot. But I also have conversations with these guys and have calls with these other firms. So it's very important, Mike.
Perfect. Thanks. Paul, how about you?
So I would tell you that I echo John's comments, like the evolution of anybody, and particularly the 58-year-old middle-aged dude that you're looking at. You evolve. And when you're young, you're full of chutzpah, and maybe you're too confident in your abilities. And, particularly being a technology investor, where since I got in the business in 1987, I've seen some real big booms and some real big crashes. And I can show you the lashes on my financial back to prove it. And so one of the things I think that has helped me is over time, I've kind of rid myself of some of those biases, and I'm more team oriented. And man, I lever the hell out of John, because there's things they do that, why would I recreate the wheel? And so, part of it is my evolution, more humble, more aggressively taking losses and moving on when they've become small losses before they become large ones. And also, we have a good thing going here. And I really like the camaraderie, the friendship, and of course that leads to, I think, better investment results.
Agreed. Mike and I see collaboration every day. We're actually side by side in our office. So I actually hear what he's doing and he hears what I'm doing. Maybe we gotta insulate walls a little better around here, but no, but the point, I guess, being like the collaboration. We'll have clients come in for the typical reviews to get a little update on what's going on, and I can evaluate what they might need from me and from our team. And I can easily then say, geez, you've got to look at your property and casualty insurance. It's definitely a really significant and important part of protection and making sure you're covered. So collaboration in our office, I think, thrives. I think a lot of organizations say that they're collaborative. A lot of them say we're going to adhere to best practices, and you hear all the buzzwords, and they try to say those words, but it's not often that it's actually being done. And I know for certain, I talked to both of you extensively about portfolios. I learn a lot, but I'm able to then convey that to our clients. So I think it's really special.
Yeah, I think we're all better together too. Everything you guys do helps us. Everything we do maybe helps you, and you guys help. So I think working together is the best approach, especially at our firm. I mean, we see it every single hour of the day. Working together just builds value and trust in our clients.
Yeah, no doubt. Just as go ahead, Paul.
Yeah, I think another thing that we should recognize is, if you're a young person, you don't know anything else. If you're an older person, you remember the days of old. But with all the internet firepower, all the wireless firepower, when I got in the business in the 80s, you had to be really in a select club sometimes to get on a quarterly conference call to check in on your companies. Now these quarterly conference calls are webinars. And if you can't listen to them live, you can listen to them archived till the end of time. And so good and bad. Now we have so much information, free, real time, available to all at our fingertips, which is a good thing. But then on the other side, when you have the fire hose of information coming at you, it is hard to decipher, which morsels are important, which are not. So it's a mix, ton of information available to all, but also how do you decipher it? So it used to be in the old days, were you in the club? Yes or no? Now everybody's in the club, but now the role is too much information. What's important?
I think that's a great point. And John, go ahead as a follow-up.
That's very important. And I think people need to understand that's one of the biggest things we do is, and I tell all my clients know this, and any prospects that come in and we talk to them, it's about all the noise, getting through the noise and determining what is most important. And I think that's what the experience Paul and I have is being able to ferret through that very quickly. I can look at the title of an article and know whether I should read it or not. I mean, I don't have to read them anymore. I could just go by the title and just delete till I hit the one that could be interesting. Or I get 2 paragraphs in and nope, not going where I thought, get rid of it. And I think that's important because when you do that, you only have so much time in a day. So if you can get through things quicker and get down to the nitty gritty and what's important, I think that helps. Besides that, people should know we have adopted some of the best technology here. And I was telling someone the other day, I can cruise through a series of income statement, balance sheets, cash flows for probably 100 companies a day. I couldn't do that before. I maybe do 3 or 4. I'd have to pull out annual reports and, pull 3 of them across each other. And, and that was the old days. Now I can get 100 through 100 of them in a day, and then we have reporting systems that'll help define the risk in the portfolios. So as managers, we can look at that and determine if it's at the appropriate risk profile we want to be at. And we can share that with clients to tell them we're doing what we said we were going to do. So it's gotten very technical, and our firm, for the size we are, is fortunate enough to be able to have these technologies to help our clients and help the managers do a better job.
And I think to summarize all that, rely on the expert is the answer, right? Rely on the people that do it every day. I love to self-diagnose any medical conditions that I have, but I don't know anything about that. So I go to a doctor, right? So
we can tell, we 3 can tell what's wrong with this guy.
Yeah, oh yeah.
But you go to a doctor, right? It's the same thing with me. I hear it all the time. Oh, I went online to buy my insurance. Well, what did you buy, right? Do you know what you purchased? And they said, oh, no, it's the cheapest thing. So it's the same thing with you guys, right? Go to the people that know what to look for and who have the expertise in, picking the right thing, unlike someone like me who has no idea.
Yeah. I also think of this, guys. I think, anybody looking out there that pays even a little bit of attention to the economy and the crisis we've gone through, these are complex times. And I think complex times call for complex solutions, not simple solutions. And I think, John, it really strikes me that, you both have not only the intellect, the education, but the experience to now take the abundance of information that you just said you can get at your fingertips so quickly, but actually you can make sense of it. Like you have a system, a process of looking at all this data and actually making really good informed decisions about that. I just want to close with this, guys, if we could, and maybe I'll get Paul your thoughts first. For those listening, not really sure what to make of what's going on, can you give them a couple tips on just what can they do as investors, whether they're new investors or even more seasoned veteran investors? What can they do? A couple little things, like a little tips to just see this thing through successfully, and hopefully they head into their own retirements in a successful manner.
Yeah, a couple of things. And, I even share this with 19, 20, 21-year-olds in the classroom. I think it is very difficult to time the market. Because the market does not necessarily respond to what's happening. It responds to what's happening versus expectations. So you could be horribly concerned about COVID or the reemergence of COVID. But if it's already widely discussed in the media, it's in the stock price. And so don't be worried about investing. I see a lot of people, and I've done it myself, overthink it. You're out of the market, and then you miss some opportunities. So I know that is not a interesting or new tidbit. Everybody says that. The other thing I think people should do, and I require this of my students, is I don't care if you're a fireman, a doctor, or somebody like me. Every day, I suggest either looking on your smartphone or listening to a podcast, all of 3 minutes, and staying in touch with the financial news. It's very easy to do these days. You don't have to run down to the newsstand and buy a newspaper. I know most of the people that are on this broadcast are conservative, and this is not necessarily a liberal or conservative call, but CNN has a podcast. It is 3 minutes long. It's called 5 Things. While you are walking down the hall in your home, you can give me 3 minutes to be updated. And that's all you have to do. 3 minutes. CNBC also has a snippet called No Surprise, 5 Things that they produce in the morning. Read a couple of paragraphs. I think even if somebody else is managing your money, I think that you need to stay on top of the financial news, either via a podcast or on your smartphone every day. And it's not all US stuff. Right? It's a big world. We're all interlocked globally. Also, make sure you don't have to be an expert, but the key points of what's happening abroad as well.
Love it. Those are great thoughts. John, how about you? Just for our listeners, just a couple things that they can do. Paul, as he said, it's not about timing markets. It's about staying engaged, being informed, regularly being informed. What about your thoughts, John?
Well, I think when you originally formed the question, you asked what we were looking at and then how we would advise our clients to stay involved and how they should be perceiving this market. I look at some things that on a macro basis help me determine my master allocation. Which direction is the market going? And for me, I think interest rates are going to stay low probably for another year at the Fed level. I think the curve can steepen. I'm okay with it. I don't think it's going to hurt the economy. I think companies are smart enough. They've learned over the last 10 years how to manage their balance sheets, their income statements even, and their earnings per share. So I'm confident we're going to see the companies I own produce some decent earnings per share, raising of dividends, buying back shares. So that leads me to believe, even though this is very difficult and things are overpriced, to be in the market and be allocated accordingly. So that's how I'm looking at it on a macro. Then diving deeper, like Paul said, keep on top of things. And then I educate my clients. I do a quarterly market report. And I also, when we meet, I try to educate them, why I did what I did, what they can expect going forward, and what I'm expecting to do with their portfolios. So there are no surprises for them. And that way, when you control their expectations, they sleep better at night and they have confidence in you. And that's what we try to do here as a team, is create confidence that our clients know their wealth is being managed. And for individuals, I would say, as you get into a market like this, my holdings start to decline because I can find less opportunities to buy or find value. I start selling some of the more expensive names and moving to other areas, or concentrating more in the names I think have value. And that's what you need to do. That's for the high net worth, the private wealth group we have. That's the kind of thing we can do to help manage risk. If you're a smaller investor and you're in funds, you still have to remain, and you have to keep putting money into those funds, even in the bad times, and just stay with it and buy good stuff and diversify.
Perfect. Awesome thoughts. And folks, we do now have the ability, as John just alluded, to help accredited investors with our private wealth group. And it's led by these individuals, John Thur and Paul Meeks, our outstanding portfolio managers. So call us for more information on that. That's going to be a wrap, folks. John Thur and Paul Meeks, thank you so much again for joining us.
Cool to be with you, fellas.
Thanks, Mike and Mike. You guys do a great job.
Thank you. Thank you. Folks, to reach us for any of your wealth management and insurance needs, call 833-FIN-GUYS or visit our website at thefinancialguys.com. For my co-host, Mike Speraza, I'm Mike Hayflick. Have a great weekend, and thanks for tuning in to the TFG Aftershow.